Brompton Funds has recently launched PAYI, the Brompton Infrastructure and Utilities HighPay ETF, along with PAYU, the Brompton U.S. Equities HighPay ETF, making these funds the second and third funds in a growing high pay lineup focused on elevated distributions, paying twice a month. To unpack the latest launches and share why a conservative shop like Brompton has entered the elevated distribution space is Chris Cullen, head of ETFs. So thank you, Chris, for joining me for this in-person interview.
Oh, definitely my pleasure, Jordan. Thank you for having me on today, and welcome everybody.
What we want to do is start with big picture, the strategy behind the HighPay ETF lineup. So, Chris, for my first question, what was the strategic thinking behind launching a growing series of semi-monthly high distribution ETFs at this specific time?
Yeah, well, we saw the tremendous growth that the high distribution space has been experiencing in the last couple of years. There's been some very successful raises of AUM, and there's a definite message that retail investors are looking for higher income, higher distributions from their covered call ETFs than we've traditionally provided. We've been in the covered call space for well over 20 years, starting in a number of our closed-end funds, and we typically would put out products that had something in the 5 to 10% distribution range. And that is, believe it or not, high by traditional dividend standards. Didn't seem like that much anymore. The conundrum that we were in was how can we offer a product that meets the needs that retail investors are telling us that they have, just by their large flows into high distribution products, while still providing a product that we felt comfortable with, that we felt was a responsible level of distributions. We saw products out there 30, 40% plus, 50% plus, depending on where you're looking. And we just didn't view that as being a sustainable product offering. We didn't view that as something that we could put the Brompton name on. So we took our time and we thought through how we could approach this space. And what we've come up with is the HighPay series. So we're targeting distributions that are reflective of what we think could be possible with total returns in a fund such as PAYU, PAYI, and our original HighPay, PAYG. So something in the high teens level of distributions we think is sustainable over the long term. And we put it together with a few thoughtful portfolio construction techniques by our PM team. So there's more diversification, we think, than you see in the typical high distribution ETF. And they're writing cover calls in a way that allows not only for high distributions, but also for capital growth in the ETFs. And so that was really what got us to where we are today, which was putting together products that we think that investors are looking for, and that we also think have integrity and have the ability to be sustained on the long term.
What investors are going to appreciate in hearing that is, especially with the reputation Brompton has, is that this fund manager doesn't seem to want to just put out quantity for the sake of quantity. So that will lead us into our next question, just about reputation. Brompton has built a strong reputation for managing conservatively tilted ETFs. How are you applying the same conservative philosophy to the new funds, which are specifically designed to maximize higher monthly income than investors would normally see from Brompton?
I appreciate you noting that we do have a reputation for conservatism, and our reputation is really, at the end of the day, that's all you have in this world. So we are looking to continue, with our methods and to continue to preserve that reputation with these high pay ETFs. And the way that we're putting them together really is thoughtful and active security selection by our portfolio management team, and putting together diversified portfolios that are constructed to provide single names in each portfolio that can generate meaningful option premiums, that have good growth capacity. But when you combine a diversified portfolio, such as our PMs have done in these products, what you find is that the portfolio diversification provides a lower volatility experience than any single name in the portfolio. It just so happens that as they put together these portfolios, we're finding perhaps twice the volatility in each name than you get in the overall portfolio. I could say it a different way, that each individual name in the portfolio, when you put them all together, the volatility is halved versus the average for each individual name. So that gives the opportunity for our PMs to write calls and write them in a way that actually provides some capital upside to the portfolio, as well as a high level of distributions. But again, the diversification does bring back that volatility and provides a more of a medium risk result than you might get in any of the single names. So hopefully that's not too much, but that's really the crux of how we're doing it. There's a lot of thought put into the leverage and the coverage and the levels of writing and that kind of thing, but that gets to the core, diversification, and providing names that you might not see in the typical ETF that's competing in the high distribution space.
Which we are going to get to. We're going to be talking about the holdings. There are going to be names that maybe investors don't normally see with other offerings that are out there, and it's usually more or less the big blue chip names that we're all more or less familiar with and experiencing a lot of overlap with. Chris, for my next question, semi-monthly distributing covered call ETFs are rapidly growing in popularity, and the series adopts that structure. Aside from obvious benefit of getting paid more frequently, are there any structural or compounding advantages to semi-monthly distributions?
I got to tell you that the entirety of the semi-monthly approach is, again, it's an investor-focused feature that we decided on, trying to offer something that people are asking for, and it's really based on the use of our perceived our perception of the use that retail investors have for these funds, which is to fund or to supplement their income. If you're going to get paid twice a month is better in many cases than once a month. People, even when we started coming up with this idea, and I showed it to my wife, and she manages our household and she pays the bills, and she was thinking, wow, that's fantastic. I love that feature because I have bills that come up at the end of the month. I have bills that come up mid-month. So that was really the thinking: make it more like a paycheck that you get paid twice a month. The compounding and that sort of thing, I mean, that's all depends on what you do. If you are using these distributions to manage your household expenses, then there's no opportunity to compound. So it's just the frequency was something that we sensed that investors were looking for.
Well, it's growing in popularity, and people are used to getting that paycheck every 2 weeks, right? Even though it's twice a month, let's not forget that. What is the general strategy for the HighPay series regarding portfolio coverage and the moneyness of the options you write?
I want to stress, first of all, that it is a discretionary approach. So our PMs are taking a certain approach currently, which I'll describe, but it may change in the future if they sense that the market has changed or just either in terms of volatilities available for generating premiums, or just the direction of the market has changed. But currently what they're doing is they're writing 40 to 50%. It varies name per name, but that would be about the coverage level. So if you've got $100 of a certain stock, you might write on $40 worth of that stock. The target moneyness that they're writing at currently is 2 to 3% out of the money. And so what does that do? Well, they're focusing on monthly writing, and if your stocks appreciated steadily all through the year, and you got called, or you got into the money every month that you wrote, that gives you 24 to 36% upside on top of the premiums that you've received. Now, the world doesn't work this way. I'm not trying to promote that as a return. It's just as an example, obviously. So that is the goal. It is to write at a level, consistently write at a level that gives the opportunity for capital upside, and not just distributions with a steady NAV.
Can you walk investors through the specific operational levers Brompton can pull, such as, we kind of talked about moneyness, portfolio coverage, leverage to maintain consistent high income while still capturing as much equity upside as possible?
Well, I described the way that currently the PMs are writing on the portfolio. what it does when you write a cover call on a portfolio, it basically desensitizes the portfolio to market movements. All right. So what I'm saying is that if you've got a heavy coverage of short options on a portfolio, and the S&P 500 moves up by 1%, the way that this fund is structured currently, the portfolio might move up half of that amount, or might move down half the amount that the S&P 500 moves down for movements around the level where options are written. And so putting 25% leverage on the portfolio increases the beta, or the sensitivity of the portfolio to market movements, back to about 1. So back to about the level where a 1% movement in the broader market would be expected to cause, a 1% movement in the portfolio again. And so this is a deliberate strategy that they're taking to write at a certain level and a certain moneyness, and then leverage a little bit and come out with roughly a portfolio that mirrors market volatility up and down.
Is the 40% rate level, is that baked into the prospectus, or could you potentially go higher as one of those levers to pull if need be to maintain that distribution?
The moneyness, the coverage level, even the level of the leverage, they're all more observational right now, and the PMs do have significant discretion to change the way that they're operating the fund in order to respond to the way that the market has moved. So I think really what that does gives them flexibility, and it gives us the ability to continue to produce a viable product regardless of the type of market that we see in the future.
What that just tells me, investors, is it's much more active management, dynamic management, and not just simply a rinse and repeat systematic way of approaching these kinds of funds. Well, we've gone over strategy and sort of the big picture. So we got to actually talk about the funds that investors are no doubt curious about, and doing the deep dive. And I think it's fitting that we'll start with PAYI, which focuses on utilities and infrastructure. Utilities are traditionally viewed as purely defensive. Does adding the infrastructure component introduce a meaningful growth element to PAYI?
Yeah, that's a thoughtful question, Jordan. Utilities, yes, are generally viewed as very defensive. They're protected companies. They're highly regulated as to what their charges are, and there's competition it tends to be excluded from that space. What we were doing when we approached this area, we're recognizing that utilities are much in demand in the retail space, and especially there's a number of examples of utilities cover call funds that pay high distributions that are very popular with retail investors. And so we're taking the concept of utilities and we're expanding it into the broader infrastructure space. There's a lens that you could look through that shows utilities as being a subset of infrastructure. So utilities are the segment of the infrastructure area that delivers services and power and water and that sort of thing directly to consumers. There's all of the other stuff that's required to make that service and goods delivery work, which is kind of like the plumbing or the piping behind the scenes. That's the broader infrastructure space. To get the gas to your house, you need a whole series of pipelines and a delivery mechanism that you never come into contact with. Expanding that focus from just utilities to infrastructure generally, it gives a couple of benefits, and there's likely more than a couple, but I'll just name two. It gives companies that are less, have less regulatory constraints and are able to grow more rapidly in the face of the huge levels of demand that we're seeing right now for their products and services. And it also gives companies that, with that growth potential, also perhaps have more volatility in the stock price, and it allows our PMs to take option positions, write calls on these stocks, and generate higher levels of premiums than they might in a defensive or lower volatility utility. Not to say we're excluding utilities at all from PAYI. We do have a number of good examples of utilities, but again, this just gives more opportunity to construct diverse portfolios, focus on growth, and allow our PMs to deliver on the distributions that we're targeting for these products.
And looking at the holdings of PAYI, there is a mix of highly recognizable names and lesser known names that we had mentioned at the top of the interview. Could you introduce us to some of these lesser familiar holdings, specifically regarding their volatility, liquidity, and options market dynamics? Additionally, is Brompton writing cover calls on every single position in the fund?
There's names, as you mentioned, that are probably very familiar. I'll use Enbridge as an example. You know, most Canadian investors have in some way some kind of contact with Enbridge and its different businesses in natural gas and in providing direct to consumer kind of energy solutions. There's a company, say, that you may not know as well in the U.S. called the Williams Companies. And it's not a mirror image, but it's a very similar type of company operating in similar businesses in the U.S. They operate pipelines, they operate natural gas and liquids distributions. Just the fact that you haven't heard of it is because they don't operate in Canada. Like pipelines, if you have a pipeline, it's located in a specific area or across a very broad area, but their focus is in the United States. So for Canadian investors, there'd be no opportunity to come into contact with the Williams Companies, but it is actually a very well-known and very well-established and very profitable business that operates in a similar sandbox as Enbridge does. Other names that I'll throw one out there: Equinix, which is it's a data center operator, and they have a large network of data centers across the U.S. and across the globe, really. And what they do is they host computing equipment for companies. And what is really needed right now by Microsoft and Amazon and that sort of thing, as they buy their GPUs from NVIDIA and other providers, they need a place that already has connectivity to power, connectivity to the internet backbone, and the ability to buy rack space in these specialty real estate locations. And Equinix has got what they need, right? And so this as we roll through the AI build out, we saw a couple of years ago there was a run up in chip stocks, and then recently a run up in memory stocks. There's a memory shortage. It's quite possible that there is a data center squeeze as we move ahead, because you're gonna find that eventually you get your chips and they all have their memory in them. Now what do we do? You can't just put it on the table and run an AI model. You need to locate at a data center and power these chips up and connect them to the internet so that you can actually operate an AI model. This is the kind of thinking, I think, that's gone into this portfolio construction, and it's not just looking for the big headline names. You've got all the headline names. You've bought them in other products, and we do have some headline names in here as well. But especially in PAYI, this kind of diversification, I think, it kind of adds to the investment thesis, and it provides that lower volatility when you blend all these different types of businesses together. That I think investors are really looking for in a high distribution product.
Yeah, and investors might be wondering, with some of these names that aren't as familiar versus maybe more overlap that they are typically seen with many of their other funds, with some of these lesser known names, as far as writing call options, is that any different with these lesser known names than, say, you might get with the more familiar names in an average income investor's portfolio?
It's a good question. There's no denying that a company like Alphabet or a company like NVIDIA, they're huge mega cap, biggest stocks in the S&P 500. They have a very highly developed option market and a lot of participants in that market, right? So you are going to get tons of availability and liquidity of options in that space, and the ability to write is very easy. The names that we're calling lesser known are still S&P 500 names. They're large companies, and they're very well developed option markets for those companies. And so there's absolutely no issues with establishing the option positions that our PMs are targeting right now. And in fact, they made sure to vet that. To vet the ability to access the option market when they made these selections. That was part of that's kind of part of the consideration. They need to be able to buy and sell the stock. They need to be able to buy and sell the options, and now let's look for leaders in the space and construct the portfolio based on that.
You know what? I take them at their word for that, because Brompton, like we had mentioned, high reputation. So if there's a options market for it, of course there is if you're launching some funds like these. And also just wanted to touch on again this kind of unique diversification you mentioned along with infrastructure, because it is interesting how it will touch a lot of these other needs that as we progress with technology, the utilities and infrastructure are going to be kind of at the forefront of that need and that demand. Now, as we shift focus to PAYU, the U.S. focused income ETF space is incredibly crowded, featuring both index-based and actively managed products. How does PAYU stand out from the competition, and what unique problem does it solve for investors?
PAYU, we recognize that there is a lot of U.S. equity high distribution product out there. Our impression was that again, it's a lot of the large cap tech names. Certain products have some additional exposure to, say, cryptocurrency and Bitcoin, that kind of thing. It seems that the goal there was to get that option premium by selecting some of the stocks that, well, first of all, are well known to retail investors, and so they feel familiar with those products. And secondly, have very high volatility in some cases, like strategy and what have you, right? That can generate those high levels of option premiums and make those ultra high distributions that they're making. What we were trying to do is again diversify and still preserve our ability to generate those premiums. Give you something else as well. Like, you don't want all your eggs in one basket with all the mega cap names. So our PMs have actually thoughtfully put some themes into the PAYU product. So there's obviously AI and AI adoption. You will see some familiar names so it's not 100% of a unique portfolio, but you can't ignore the major AI adoption theme that's happening and it's creating a lot of value just in global capital markets. And so you do see some of the names: Microsoft, Amazon, NVIDIA, in these products. Some of the names that you might not be familiar with, I'll give you one example, is Corning. Corning is heavily involved in the AI adoption story, but from a different angle. What they do is they make high-tech glass products, and cable for optical fiber cables are a key product that they produce. Data centers have a lot of chips in them, but how do you connect them all together, and how do you connect them to the main internet pipeline? You need cable. You need sometimes hundreds of millions or billions of dollars of cable. And so this is a company that kind of comes at the AI story kind of from the side, but is got very good prospects in terms of demand for their products and growth due to increased demand for data centers and the like. Another theme that our PMs are targeting currently is demographics, right? We're living in a society where the largest demographic cohort is aging rapidly. They're quite well off. And so their needs are also changing as they move ahead in their lives. You see some names in this product, the PAYU product, like Eli Lilly or United Health. So Eli Lilly Pharmaceuticals. United Health is a managed healthcare and insurance provider. Both premier names in their spaces, and both serving an aging population in a way that has a very good prospects for their businesses going forward, just because of the way that aging affects your need for those products. Another one in the demographic space that you might not see so often is Tapestry, and that is really just a luxury goods owner. It's a holding company of various brands like Coach or Kate Spade. And that kind of reflects kind of the growth in wealth that some of the older demographics are seeing, and the spending that kind of goes with that on luxury goods. So a couple of interesting ideas, I think, in terms of participating there. And then finally, in PAYU, infrastructure is also a core theme. So you will see some of the same names as you do in PAYI, but also some names that you don't. GE Verona is one of the names that our PMs have selected for this particular portfolio. It's a spin-off a couple of years ago from General Electric, and what they do is they build turbines for electricity production. They're involved in building windmills, or blades for windmills and that sort of thing. And so lots of participation in building the things that are needed for the energy space. One of the interesting aspects too that I just want to loop back on for that infrastructure theme and for PAYI that I'd like to highlight is that infrastructure, like as far as like owning a pipeline network, that's going to be very profitable in the future. But if there's not enough pipelines out there, you got to build new ones. And so our PMs are not only looking at infrastructure and utilities or infrastructure in PAYI or infrastructure in PAYU, but also in suppliers to those industries. Because while you're waiting for a new power plant to be built to power your AI that you need, the data centers, just to run your AI network, you also need to build it, and the companies that are providing supplies to build and services to build those infrastructure projects are the ones that are making the money in the interim. And so that's a very big focus as well when they're looking at infrastructure for either PAYI or PAYU.
The sector makeup of PAYU is surprisingly well diversified rather than dominated by mega cap tech. Why are consumer discretionary, industrials, financials, information technology, and healthcare so evenly weighted? I know it's not an exact one for one, but they are fairly close together, and I take it that was strategic.
These are meant to be concentrated portfolios of leaders in the individual spaces that the companies compete in. The diversification I've talked about already as to why that's a benefit to a product like this. You don't want to have the entirety of your bets on one horse when you could bet on a whole stable of horses, right? Hopefully each of them will come out as winners. They already have dominant positions or leading positions in the different industries that they compete in, and they were all selected because of that and because of their prospects in the future. And when you bring all of that together, there's different things affect different sectors in the market. Interest rates might have a different impact on consumer discretionary as it does on perhaps energy stocks, right? Like I'm just throwing some examples out there. But again, putting that all together, it kind of protects your investment because you do have a whole bunch of different exposures that are built into one portfolio. Right. Brings down that volatility.
I think investors, at least as one that, of course, invests in covered call ETFs, what I'm hearing as well that maybe separates the HighPay series away from maybe competition is, of course, you're getting away from this sort of overlap that investors might be experiencing with other products out there, semi-monthly payer, elevated distribution, making it much more attractive. High reputation, of course, conservatively tilted fund manager. Along with these two launches of PAYI and PAYU, you also have two other ones upcoming.
Oh, yeah.
You also have two, PAYT, the Brompton Technology HighPay ETF, and PAYB, the Brompton Financials HighPay ETF, that are coming soon. What can you tell investors about those two funds?
Well, there's the very high level, obviously, a technology and a financials kind of leg of the. How many legs do we have on our stool now? We'd have 5 legs to a stool at that time. Yeah. Anyways, it'll be our financials and our technology offering. We can't talk too much about the specifics of the portfolio yet because that is subject to change and it's not a public fund yet or anything like that. But you get the idea that there will be financials and technology holdings, and we will take a similar approach, concentrated portfolios of leaders in the specific areas that they compete in, and writing cover calls to a level that we think is a sustainable, produces a sustainable distribution that's high, that's attractive, and that allows for some capital growth in the portfolio if that becomes available.
Well, Chris, thank you for joining me today in your beautiful office here to talk about these funds, PAYI and PAYU. And investors, let us know in the comments below what you are thinking or what your opinions are about what Chris has told us about the structure of these funds, the call option writing, the leverage, the overlap that is getting away from much more maybe traditionally built portfolios. But as always, hit all the buttons of the like and subscribe variety, and we'll see you all in the next video.